Breaking news today, and it's shaking the global currency community. Reports of a confidential bank memo suggest that Wells Fargo and Chase may have set official contract exchange rates for the Iraqi dinar and Vietnamese dong. This leaked document allegedly lists a potential locked rate of 4.9 per Iraqi dinar and around 3.10 per Vietnamese dong, sparking an unprecedented wave of excitement among long-term currency holders. If verified, these numbers would mark a massive shift from speculation to tangible financial planning. Today, we will explore what this development could mean, how the exchange rate lock might work, and why it has captured the attention of investors worldwide. This is a story that could redefine the way private and institutional investors view the Iraqi dinar, Vietnamese dong, and even other high-interest currencies, creating a momentous opportunity for those prepared. The leaked memo reportedly establishes a very specific set of rates for currency exchanges, suggesting that financial institutions are preparing for a carefully controlled process rather than leaving currency revaluations to the open market. Traditionally, foreign currency markets are volatile, with rates determined by supply and demand. A contract rate, however, guarantees a fixed rate within a limited window, offering private investors a level of predictability rarely seen outside large institutional dealings. The idea of a managed exchange rate window hints at a serious, coordinated effort to manage liquidity and stability. For Iraqi dinar holders, this could mean that long-held currency might suddenly have a calculable and significant cash value. Meanwhile, Vietnamese dong investors could see their previously undervalued currency appreciate substantially in a controlled, predictable manner. The core of the discussion revolves around the concept of an exchange rate lock. Unlike normal market fluctuations where rates can change minute by minute, an official contract would set a rate for a very narrow time frame. Sources suggest that this window could be as short as 48 to 72 hours, emphasizing urgency and readiness for participants. For the Iraqi dinar, the suggested 4.90 rate is far above the current trading levels, which could turn long-held currency into a life-changing asset. The Vietnamese dong rate of 3.10, while less dramatic in absolute numbers, represents a structural appreciation that could be significant for holders who acquired large bundles at extremely low cost. This kind of organized rate locking is extremely rare and indicates a level of planning usually reserved for critical systemic events in global finance. If this memo is legitimate, it reflects a profound strategic effort by leading U.S. banks to stabilize potential surges in market activity. Massive investor interest in currencies like the Iraqi dinar or Vietnamese dong can lead to sudden runs on banks or exchanges, overwhelming systems, delaying settlements and causing chaos in broader markets. By establishing a contract rate and a short operational window, the banks would essentially create a buffer period to manage liquidity, ensure orderly transactions, and reduce panic-driven market reactions. This is a method usually applied at institutional levels or in coordination with national treasuries, making its potential use for private currency holders particularly noteworthy. Investors who act prepared within this window could secure substantial financial gains. The memo reportedly doesn't only cover rates but may also define the operational procedures for currency holders. This includes compliance checks, required documentation, and step-by-step guidance to ensure smooth exchanges. Currency holders would need to have all receipts, account information, and original notes ready before the window opens. Those who fail to prepare might miss the opportunity entirely. The emphasis on preparedness is critical. This isn't a scenario where casual or last-minute action will secure results. By formalizing the process, these banks could democratize access, giving everyday currency holders a chance to participate in what could otherwise be an institutional-only opportunity. This could fundamentally shift how T4B investors interact with undervalued currencies. Psychologically, the significance of a rate lock cannot be overstated. For years, Iraqi dinar and Vietnamese dong holders have endured uncertainty, with revaluation discussions often relegated to online forums and speculation-based communities. A confirmed locked rate transforms the conversation from hypothetical to operational. Investors now have a potential benchmark to plan their financial future. This structure reassures private holders that if they act correctly, they could secure substantial returns regardless of market volatility. In other words, speculation evolves into actionable investment planning. For many who have held these currencies for over a decade, this could finally validate their patience and commitment, turning what was once a gamble into a managed financial opportunity. Operationally, the memo reportedly prioritizes coordination with U.S. Treasury systems. The banks named, Wells Fargo and Chase, are historically trusted institutions with deep ties to Treasury operations. This adds a layer of legitimacy to the supposed memo, suggesting that if executed, the process would be monitored and supported by federal oversight. Currency holders might not just be engaging with the banks alone. They could be participating in a carefully controlled, federally observed financial transition. This collaboration would mitigate risk, reduce the chance of fraud, and provide security for individuals attempting to access what could be substantial payouts during the rate lock window. One of the most intriguing aspects of the reported rates is their alignment with broader economic realities. Iraq, for instance, is a major global oil producer, and its foreign reserves and revenue streams support the notion of a significantly higher dinar valuation. The Fort 90 rate aligns with some analysts have suggested based on oil output and macroeconomic stability. Similarly, Vietnam's economic growth, foreign engagement into global manufacturing networks suggests that the dong could structurally appreciate. The 3.1 figure, if accurate, reflects this potential. For Zimbabwe, although not as widely discussed, the emergence of asset-backed currency strategies may similarly create structured payouts for holders of the Zimbabwean dollar. This alignment with broader economic fundamentals adds credibility to the memo's reported figures. For private investors, the implications are profound. A single high-denomination Iraqi Dinar note could be worth over 100,000 and does at the reported 4.90 rate. Even smaller denominations could generate substantial returns. Vietnamese dong holders, often having purchased bundles for negligible amounts, could realize thousands of dollars in value, dramatically changing financial circumstances for individuals. Even currencies like the Zimbabwean dollar, long dismissed due to hyperinflation, could now represent a structured investment opportunity if backed by tangible assets. The memo's reported figures provide hope that disciplined action could transform speculative holdings into real, life-altering assets. Experts suggest that acting within the short window is critical. Preparation, discipline, and speed are expected to be decisive factors for participants. Organizing currency notes, verifying documentation, and understanding contractual terms are essential. Those who delay or fail to follow proper procedures could miss the locked rates entirely, leaving their holdings subject to normal market volatility. The memo's operational framework reportedly emphasizes this urgency, ensuring the process is orderly and equitable while preventing market chaos from overwhelming the system during a potential surge in exchanges. The strategic rationale for the memo also points to a broader global perspective. The locked rates and managed exchange process could serve as a rehearsal for a larger global currency realignment. By controlling the transition for a select group of investors in the U.S., institutions can test operational systems, coordination with treasury mechanisms, and liquidity management strategies. This process could then be replicated or adapted for other undervalued currencies worldwide, providing a blueprint for managing currency appreciation events while minimizing systemic risk. This represents a potential paradigm shift in global monetary strategy, moving from speculative to structured, managed transitions. Currency holders must also be wary of authorized exchanges and scams. Only federal-backed banks with proper coordination can provide the security necessary to guarantee these rates. In the past, speculative excitement around Iraqi Dinar and other currencies has led to scams and fraudulent offers. The memo's procedural emphasis reinforces the need for vigilance. Participating through recognized banks ensures protection, legitimacy, and a chance to capitalize on potentially life-changing rates without unnecessary risk. Following the rules and working through established channels could make the difference between success and financial disappointment. Another key element reportedly covered in the memo is the possibility of structured payout contracts. Instead of receiving a lump sum, participants might receive funds gradually over time. While slower, this approach allows banks and federal systems to manage liquidity, preventing shocks to the financial system. For individual investors, this ensures security and predictability while still providing access to potentially large financial gains. This step demonstrates a focus on sustainability and prudence, even amidst potentially historic revaluations of the Iraqi dinar, Vietnamese dong, and Zimbabwean dollar. The memo's implications also extend to investors' psychology. By providing a predictable rate, investors gain confidence in their financial decisions. No longer must they worry about being outmaneuvered by large institutions or sudden market swings. The playing field is leveled to an extent, allowing smaller private holders to participate on more equal footing with institutional players. This psychological boost could drive readiness and prompt decisive action, which is exactly what the banksite intended in preparing for the short operational window. For Iraqi dinar investors specifically, the memo's suggested 4.90 rate represents a potential milestone moment. Longtime holders, many of whom have waited decades, could finally see the payoff for their patience. Even modest holdings could turn into life-changing sums, creating personal and economic opportunities previously considered impossible. Similar logic applies to Vietnamese dong holders, particularly those who have acquired currency in bulk over the years. The possibility of securing a fixed contract rate removes much of the uncertainty that has historically kept mainstream investors away from these markets. The memo's potential effect on the global currency community cannot be overstated. If contract rates are confirmed, this could encourage broader adoption of structured currency revaluation methods, moving beyond speculation into operational reality. Countries and financial institutions observing the process could implement similar mechanisms, creating a new framework for international monetary stability. For U.S.-based currency holders, this could be a transformative opportunity, but it also underscores the need for meticulous preparation to ensure successful participation. Practical steps for investors: if this memo's details are accurate, are clear, organize currency, gather all supporting documentation, understand available contractual rates, and be ready to schedule appointments immediately once the window opens. Delays or errors could result in missed opportunities, while full preparedness may secure significant financial gains. Currency holders should consider consulting with trusted financial advisors to ensure every requirement is met. Acting swiftly and responsibly could define the difference between extraordinary success and lost potential. In summary, the leaked memo allegedly outlining 40.90 Iraqi dinar and 3.10 Vietnamese dong contract rates represents a potential turning point for private currency holders worldwide. With the promise of a locked rate, strict operational windows, and coordinated federal oversight, this could be the most structured and investor-centric approach ever seen in these markets. Discipline, preparation, and immediate action are likely to determine who benefits and who misses out. Today, the message is clear: the potential for historic returns exists, but only for those ready to act decisively within the framework reportedly set by Wells Fargo and Chase. The coming days could redefine currency investment forever.